On this episode, I interviewed Spencer and Ashley. They are short-term rental experts. So they've been doing this for a long time. They've set up a pretty big business around short-term rentals. And they talked about also expanding from the Ontario market towards New York. So there's some really cool things that they've done, really cool tips on how to increase your nightly rate or daily rate. I don't know, however that works. And there's also some really cool things on what to look for, how to look for the right property if you are looking in Ontario or outside of Ontario. So I think you guys will really enjoy this episode on short-term rentals. If you do, please make sure to share this with a friend or family member. That's greatly appreciated. And leave us a review. A 5-star review would be amazing on the Apple Podcast platform or on Spotify. And then finally, if you want to download some great reports, we've got some on multi-unit renovations, the order in which to renovate certain things if you do have a multi-unit. We have one on IKEA kitchens under $1,000, how to set that up. So there's tons of value in there, and you can download it all for free by going to www.welloff.ca/report. Enjoy the episode. All right. I'm here with Spencer and Ashley. It's the first time we meet. I think we've been kind of in touch for a while, back and forth, but we live quite far away. But anyway, just usually when I start off, I like to ask you guys about like where you grew up. So if you want to just kind of start off by telling me a little bit about that.
Ashley and I are a little bit different. I grew up up north near the Owen Sound area, Grey Bruce, if you want to call it that, but moved to the Niagara region when I was about 10 or 11. So again, went to university at Brock there. And I've been in Niagara probably the majority of my life.
And then I was born and raised in St. Catharines, Ontario. So Niagara my whole life.
Yeah. Are you Italian?
I am.
Yeah, just from the last name.
Yes,
Italian.
Both my parents.
Okay, cool.
Yeah.
All right, so let's talk about this short-term rental thing. So obviously you guys kind of specialize in that. Do you want to just give people that are listening an overview of what you do and kind of the services?
Sure. So we have always been big in the short-term rentals. As soon as we got into real estate, Spencer started in the short-term rental industry. So we've been doing that since like 2018, I think now. We own multiple properties, a few in Canada, a couple in the US, all short-term rentals. And then Spencer and his friend have a long-term apartment building out in St. John. Mm-hmm. And then we have a management company that specializes in short-term rental management that manages about around 50 properties across Canada and into the US as well.
All right. So this is, it's a very interesting thing because there's a lot of ups and downs kind of, over the last 2 years when it comes to short-term rentals. There was a huge boom where everyone was doing it and then kind of people stopped really talking about it. So what do you guys see what do you think happened in terms of that boom and kind of that maybe not as much interest anymore? It seems like, I don't know, is that the case or?
Yeah, there was definitely like a gold rush, if you want to call it that. I mean, there was, it's just kind of like the same thing with cryptocurrency. There was a ton of people talking about it on social and like the cash flow is extremely strong and all these success stories. So yeah, everyone kind of jumped on the bandwagon. But, 7, 8 years ago, you could pretty much put a mattress down and as long as you had a roof over the head, you would make okay money. That's not the case. Mm-hmm. Like a lot of people flooded the market, made the markets a lot more saturated. And really where we see the big divide is the people that are doing it seriously and full time and doing it properly, setting it up, revenue management, decorations, like making it like a true vacation rental. Those are the ones that are still having great success. And the ones that kind of, I'm going to try this out, see how it goes. Those are the ones that kind of got hurt and didn't do nearly as well.
So do you find that a lot of people are doing this kind of as a business right from the beginning, or is it because they're backed into a corner, their rates have gone up significantly, so they kind of have to find a way to generate more income?
Yes, that's what I think a lot of them are doing. And you can tell. A lot of our clients have come to us and they were like in the flipping business or they were long-term investors and they realized that they're not going to get the return that they were once going to get. And so then they want us to try short-term rentals. And for us, we come in there usually at the very beginning when they're doing this and we're like, you're going to have to put in X amount of money. And it's really hard for them to wrap their head around. And then we usually have to battle with them like, no, you do need nightstands. Yes, you do need a TV. You can't go live before you have all these things because it's going to hurt their listing because they just see the money out. Mm-hmm.
Mm-hmm. So can you just kind of give me an idea, like how would this work for someone who's, let's say they're like negative $1,000 a month on their property
and they see the short-term rental as an opportunity to get out of that hole. Can you kind of give us a breakdown of what those numbers might look like and how they can make it work?
Yeah, I mean, I think like there's still a due diligence phase, whether you own the property yet or not. I mean, I think we have a lot of clients that come to us with that situation, and we kind of lay out, here's the projections based on, if you do X, Y, and Z, it's going to cost X amount of dollars. If these numbers make sense, do it. And if you're going to do it for just a year, doesn't make sense, because furnishing an entire property, amenities, that kind of stuff, it's not cheap. But a lot of the times there is a return there, but you have to lay it out to the point where it's like, hey, this might take a year till you recoup this investment back, but then year 2, you're profitable. Or it might come to the point where it's like, hey, it doesn't make sense. Maybe, you can stop the bleeding a little bit, but it still might be in a negative situation. So I would say due diligence is kind of like the number one thing to do, even in that stage, for sure. But a lot of the times, like, it's just laying out the cards, being like, this is what you need to do to get it up to this income for it to make sense.
And part of that due diligence phase that he's talking about, like, there's programs online that can help you with that. So we use AirDNA a lot. We have a subscription, and that's what we use to say, this is what we think your house could earn as a short-term rental if it is up to standards. So location obviously is big, but if a house down the street on the same location, same type of house, is gorgeous and done up and has all the outdoor amenities like hot tubs, saunas, that type of stuff, then yes, that house might make 6 figures. But just because your house is on the same street and you just put like your grandma's old couch in and some old stuff, like, that doesn't mean you're going to get that same return.
Yeah, and just wanted to add to that too, because AirDNA is a great subscription model, but it's much more than just plugging your address in and it giving you a revenue, because it can work both ways. It can show really high numbers that excite you, or it could show really low numbers that would turn you away, but both of them might be incorrect. So you really need to, to Ashley's point, take a look at what it's comparing it to, right? Go in and look at the listings. How is it done up? Because if all 10 comps are rundown properties and they're showing really low income, that could be an opportunity for you to be a leader in the space and crush those numbers, and maybe looking farther out into, okay, like, what are the top revenue hitters doing and what do they have? It might not be in that same neighborhood, but maybe, a few blocks over at a different subdivision, there's properties that are doing 6 figures and they have hot tub saunas, things like that. And vice versa, it could be showing that you're doing, the incomes comes in at 6 figures, but all of these properties have those nice amenities and you weren't planning on doing it. So you can't expect to get that unless you mimic success.
And you mentioned grandma's couch. So do you think that you could be successful, like, for the people that are using whatever old furniture they might have laying around, just like an older TV, put it in the property? Is that still an option that can work? Or do you really feel like you have to kind of buy new and have a modern space and that sort of thing?
Yes, as long as it flows. Like, I'm thinking grandma's old couch is not flowing well with the space, and it really depends on like what you're trying to go for. Like, we prefer that the house is all one color. We want all the bedding to look the same, very uniform. It pictures better. So whatever is going to photo better, and then also just be comfortable. There's things that we skimp on as well, like things like end tables and stuff. You can get them IKEA for pretty cheap, but things where it's like high traffic items, couches, mattresses, dining room chairs, that stuff, I'd go a little bit higher end just for durability. But don't spend $5,000 on like a dining room table, and you don't need like a brand new couch set if yours from 6 years ago is in good condition. But we have gone into homes where they've pieced it together, where it's like, oh, this couch was in our basement, that was donated to us, we found that at the side of the road, and it shows, and it just doesn't photo well, and therefore we can't charge high rates because no one would pay it.
Right. Yeah. So, I mean, at the end of the day, you can probably like fill the vacancy if you have old furniture, but you might not get the sort of numbers you need to make things work, right?
Exactly.
Yeah, like, it comes down to the photos. If you stand back, I mean, like, look at this room. You've got some decor in here. Like, it looks good. When you stand back and just look with your eyes and see if this is going to photo good, sure. But if you stand back and you're like, this is going to look kind of awkward, and it's not grabbing my eye now, it's definitely not going to grab the guest's eye when it goes up on platforms like Airbnb. it still needs to look good. That is like, you have like less than 2 seconds to grab someone's attention. If you have nothing in your house that does that, people are just going to swipe.
And the other thing too, sorry, just to add to that, is even if you do charge the higher prices, and let's say you get 1 or 2 bookings, those ratings might not be good, because they could walk into the house and be like, I paid $2,000 for a weekend for old furniture in a house that doesn't flow, which would just impact your listing if the ratings are bad, because ratings are everything.
Yeah, definitely. Can you share like kind of what the numbers look like in the Niagara region? Is that kind of where you focus mostly? I know you're across all of Canada, but if you can just kind of share some of the numbers. Sure.
Yeah, I mean, I think it's best to kind of start with like the income potential, because obviously there's different pockets in Niagara and real estate prices are kind of different, 10 minutes down the road from each other. But I mean, we're seeing some of the top performers doing over 150,000 gross revenue per year. So you can always work backwards from there. Niagara-on-the-Lake is probably our favorite place out of everywhere in the Niagara region, just because they have a very cut and dry license process in terms of just being able to operate there. It doesn't need to be a primary residence, which we love. So there's scalability to that. And Niagara-on-the-Lake itself is very pro-tourism, right? And they're more than likely always going to have this as an option, which we like, right? We think long-term longevity. So yeah, I mean, the ones that are done on the high-end side, you're looking at 150 plus. Obviously, you can look at some numbers. Like, we've bought properties 4 or 5 years ago that do those numbers at, 400 or 500 grand. So like, obviously saying the cash flow on that now is not as realistic, but we have a few $1 million properties in Niagara-on-the-Lake that still cash flow well over $2,500 to $3,000 on average per month, right? And that is with variable rate mortgages. So there is still opportunity, but again, we had to spend a lot more on the finishes, the outdoor amenities. So yes, it's taken us a year and a half to recoup that additional money back. But we're treating this like a hotel. Like most major hotels, when they go live, they don't break even in year 1 in terms of all the money that they've put in. But again, you do need to set that expectation of like, hey, I don't want this to take 10 or 15 years either. So there's still a ton of opportunity, I think, like Niagara-on-the-Lake. St. Catharines too, they're a bit more tricky with their license. They have one. They're just a lot more of a difficult city, but the real estate prices are slightly cheaper. So again, there is some opportunity there, but yeah, lots of opportunity to cash flow.
So it sounds like, I mean, this is just kind of what I'm getting, but it seems like it's better to get into this space with the intention of doing it right from the beginning, as opposed to like kind of saving yourself from a bad situation. Would you guys agree?
Yes, like you want this to be intentional. And even if you do have to save yourself from a bad situation, it is what it is, then make it intentional afterwards, that you do need to invest in the property in order to get a return. And for Niagara-on-the-Lake, where Spencer was talking about, like one of the biggest things is not being in like a subdivision. These properties that are doing 150 plus are mostly like vineyard views. They have those amenities that we're talking about, the saunas, the hot tubs, all of that stuff. So it is a big upfront cost. And on top of that, we are reinvesting in that property year over year over year.
And what about the people that are like saying downtown St. Catharines? So maybe you're not in the best area. Well, obviously not. And you're looking to do a short-term rental. Is that something that can work? Let's say like, you're in an area where there's homeless people, there's drugs, there's stuff like that. Is that something that could work as well? Or would you say stay away from it?
I mean, it's not our style, but there are people that do it and have success with it. I mean, it's not just short term. There's a lot of people doing like what's called medium term, which is over 29 days, which kind of, you don't have to deal with a lot of the red tape with getting a license. And there are a lot of people that come to that city, for example, and a lot of these like, decent sized population cities for medium term stays, 1, 2, 3 plus months. They might be here on a work contract, or they might be in between renovations at their property. They're visiting family. We've seen a lot of success with those types of properties too, that are just more like your no frills, still nice, like comfortable bedding, good kitchen amenities. Like you still need those things if people are going to be staying long term. That definitely works. From a short term perspective, I mean, there still is the budget traveler. We like to personally stay away from them because we do find that they can be a little bit more difficult to deal with, just because their expectations are here when we try to lay out the expectations are, for this property specifically might be here. But not to say it doesn't work. It's just we're more personally experiential type vacation rental house. We want, the higher end amenities, the people that are coming to town for vacations and to really enjoy tourism in the city, not so much the medium term stay, but that can work.
And what about financing when it comes to these types of properties? So let's say, like that Niagara on the Lake place that you bought, you're buying it, you're really operating it like a hotel. So you can't really kind of look at the financing the same way that you would as a normal home. Are lenders recognizing Airbnb or whatever short-term rentals as a source of income and treating or basing the mortgage on that?
Well, that is the tricky part. Don't know when this is going to air, but this will change every single day. When we were starting, they were, yes, but then there's talks of most A lenders not touching it just because of the fact that it is unpredictable income, and a lot of the times, like you definitely need to disclose what you're going to do with the property. So, I'm not a mortgage broker. I would just say if you are looking to get into the space, reach out to somebody who is. I know that might not be a direct answer, but there are B and C lenders that supposedly are taking a look at it. But again, this stuff changes every single day.
Yeah. So the last time that I did a podcast, I had a guy who they buy apartment buildings, and then he said he converted like a little closet sort of behind the elevator. It was like a relatively big closet into an office space. And I was thinking, well, did you guys look into like running Airbnb or doing something like that there? Have you guys ever dealt with that sort of situation where, like in a commercial area, in a commercial property, maybe somebody turns a room into a little rental?
We have, so typically in terms of management, we only take on full homes because we are looking for the upscale luxury. We do happen to have a client in Niagara on the Lake who actually owns an insurance brokerage and created a unit on the upper floor and just built it from scratch and runs that as a short-term rental and has a license on it and everything. So that's the only one that we've dealt with, right, in a commercial space.
Yeah, no closet spaces.
No closets.
Again, hey, it can work. It's smaller fixed costs if it's allowed. That there's a little bit less risk I would see with that because you're not spending $50,000 in furnishing the place. But yeah, typically we stay away from that stuff.
Yeah, I don't know if it was a closet. I think it was like an elevator room or something like close to the elevator. So it was probably, I'm guessing, like 200-300 square feet. But yeah, things are getting smaller and smaller. So I don't know if that would work. So how would that work anyway? If you do have, I don't know if you guys even know this because it might not be your thing, but like, let's say you do have a commercial space and you wanted to like that client of yours, would you just need to apply for the license and kind of go through that standard procedure, or is it a little bit different in that situation?
No, you'd still have to get a license. Like, we like to do everything by the book. You don't want a city on your bad side, right? So you would still have to go through the license. And I think the biggest one would be parking is usually really big with the city. So you have to make sure that there's enough parking for the guests and all of that stuff. But if it passes, then and it works, then that's fine. And I think that would be great. Like, again, not our bread and butter.
Yeah,
we like to do like, we always find when you get a lot of people in a tight space, there could be issues between long-term and short-term. So maybe some of your long-term guests really don't like having a short-term tenant in there. Maybe the short-term tenant isn't a great one and causes problems or whatever the case may be. We just prefer to not do that.
Yeah, okay. And every municipality's zoning is going to be different, right? Some of them, if you're in a commercial zone, might just say, you're commercially zoned. You can do what you want. A lot of them will have licensing that you'll need to, get fire inspection, that type of stuff before getting approval. So I would just say, like, wherever you're considering to do that, just take a look into the city zoning. I personally am old school. I just like to call the city being like, here's what I want to do. I know I'm reading it on here, but there's articles from 2019 and your bylaws from 2019. I just want to make sure we're good to go. Just because you don't want any unpleasant surprises after you've spent the money to get it up and running.
Yeah, for sure. Why don't we shift over to your New York properties? So can you tell us a little bit about that and just kind of an overview?
Sure. So we have two properties in Ellicottville, New York. It's about an hour and a half from Niagara, so not too bad of a drive, depending on the border. It's a ski town. So what really drew us to that was having properties that did well in our low season. So our high season in Niagara is typically between May and October. And then slow season is really like January to May. And basically the high season there is the opposite. It's between January and April for the skiing. So that really drew us there. The pricing at the time, we bought them in 2021, I believe, was really good. I think we bought one just over about 530, and then the other one for 250. Very little renovations had to go into them, just a lot of like setup costs and stuff. And the mortgages in the US are just very attractive because they have that true 30-year, and we locked in a pretty good interest rate. So yeah, they do really well for us, but that's what drew us to the area.
Can you share some of the numbers? Like what are you guys getting in rent and that sort of thing?
Yeah, I mean the more expensive one is like steps away from the private ski hill. It's literally like a 30-second walk to the ski lift. So like that's what really drew us in, and it's like a true chalet style property. That one, like I said, we bought for 530. We were able to get 80% LTV, so 20% down. In terms of the total cost put in, the nice thing about it is, like, here's a good example. That house came fully furnished, and there was a lot of furniture in there that actually worked, right? Like very nice wooden tables, like really cool bar stools. You know, the couches and stuff fit the theme, coffee tables. So like we were able to roll all that furniture into the mortgage, which was huge because that would have cost us an extra $30,000 to $40,000 right there. But what we did add is it didn't have a hot tub, so we put a hot tub in, and it had a lot of deck space, but it didn't have really any good outdoor furniture. So we invested in really high-end, like luxury patio sets, gas fire table, a lot of like those Adirondack chairs on the front deck, string lights. That's a really big one. So I'd still say we probably spent about $20,000, maybe $25,000 US additional to outfit the place, which relative, it's pretty inexpensive from what we've done in the past. And that property, I mean, in year one did, I think, 130,000 US. I think it's in and around 140 every single year over year now. Like the first year is always usually typically your slowest because it doesn't have a track record, doesn't have reviews or ratings. But we locked in at a 2.64 interest rates, and that's for 30 years. It doesn't change after 5. So, I mean, all in, I think our covering cost is just shy of $4,000 a month. So it cash flows, you know, a decent amount month over month. And then our other property we bought for $250. That one's actually I'll even stronger cash on cash return because, again, same thing. It came furnished, but we probably got it, I'd say, about 40% of the furniture that was in there. Like we replaced the dining chairs, I think we did a few mattresses, end
full
tables,
living room
the
too.
full living room we redid. And that one we spent a little bit more on the outside. We put a covered gazebo, hot tub, fire table, same thing. Like that's the bread and butter, the outdoor space. But because, again, the cost to acquire was same thing, 80% LTV. I think our covering cost on that is less than $2,500 a month, and that does 110, 120 a year. So in terms of the cash flow, it's really good. But for that property, we've slowly reinvested. Like year one, I think we only did 65, 70. We put the hot tub in a little bit later, just given COVID, and getting over the border was a challenge, and getting anything ordered was a challenge. And then recently, last year, we had a fully detached garage that was service insulated, electrical, had heat pumps in there. It was just sitting empty. And we thought we need to turn this into something cool. So we designed a really, really neat games room. Like, it's very arcade themed, pool table, TV, basketball shooting, Pac-Man machine. And since we put that in, that cost us about $8,000 or $9,000 US. We did a lot of the work ourselves, and we've already seen over $20,000 improvement versus the previous year. So just a good case study of, like, investing into your property does make sense.
I think we actually ran the numbers over the last 3 years recently. So the first year, like he said, we did about 70,000. We put the hot tub in. The year after, we did about 80, ish. So we basically made the hot tub back in year 1, and then we spent the 8 or 9 on the games room, and we're going to clear 6 figures this year. I think it's going to be about 110, we think, by the end of the year, which is crazy on a $250,000 investment.
Is that your best project, would you say?
That's our best cash on cash return by far in our entire portfolio. And it's not, from the outside, it's not like the best looking house. It's a small little schoolhouse, and it doesn't give ski chalet vibes the way that our other property in Ellicottville does. But I think what does well is because it's on a very big property. It's just under an acre, kind of in the country. So it has 2 high seasons. People still come in the winter for the skiing, but it's very cottage-like vibes in the summer because it's got a lot of land and you can look at all the mountains and stuff. So our 2 best months this year were January and June.
Cool. Those sound like really interesting projects. Are you going to do more of them, would you say?
Yeah, we're always looking. Like we're putting in offers like constantly out there. The thing with that market in upstate New York in general, I still think is a great opportunity. We just really like Ellicottville is that there's not a lot of supply. It is a smaller area, and a lot of people have had these places for generationally, like they passed them down kind of thing. So it's not something where you're going to go on Zillow and like see something right away and be like, okay, this makes sense. It's just one of those things where you ask around, you get to know the people, right? We've got good relationships with realtors and maintenance people there. And, when word hits the street that someone might be interested in selling, that's kind of where we try to get the advantage of, okay, like let's go put an offer in, because even now with interest rates being 7-ish% out there, the numbers still pencil really, really well with the right property, and cost to acquire is a fraction of, even with the exchange, what it would be here. So yeah, like going back to like the games room that we added in Ellicottville, it can be daunting when you're looking at a property and seeing, okay, I want to add all these amenities, a hot tub, a sauna, a games room, but it can get very costly. If you can do it at the beginning, absolutely go for it. Like that's kind of our strategy now, is like we want to hit the ground running if we have the resources to. But for someone that's new and starting out, I would just suggest taking a look at like the one major thing that you can do for now, but use the profits to reinvest year over year. That's what we did with the games room in Ellicottville. That didn't happen until like year 2. Right, we knew we wanted to do it. It's just okay. The hot tub was the most important thing in a ski town, so we bit the bullet on the hot tub. We put that in, knowing that hey, the games room's going to be next, and we reinvested the profits into that. Because really, when you think about it, it's like a lot of real estate investors get focused on, okay, I've got this rental property. It's making me $1,000, $2,000 a month in cash flow. Now I need to go get another rental property so I can make another $1,000 or $2,000 in cash flow. The issue with that is a lot of the times it requires 6 figures to go and buy that property, which what we love about short-term rentals is we can maybe take 10 to 20 grand, invest it within, and extract that $1,000 to $2,000 extra a month in cash flow. So the return is like 10x plus better than having to go spend another 100,000 on a new rental property or 200 grand. So we're always looking for ways to optimize the listings and looking within. And that goes from doing a ton of research, like using platforms like AirDNA, or just strictly going on Airbnb and going through the filters, right? One of my favorite exercises that I love to do, and it's something that anyone can do this day, and it's super applicable and powerful, is search an area that you're looking to invest in. Search on a very flexible calendar, so any week. So you're seeing pretty much every property that exists. It will give you a number. It might say 500 properties, 1,000 plus, 2,500 properties. From there, start clicking one by one amenity filters. So see, out of that 2,500 properties, how many people have a hot tub, right? So from there, it might go from 2,500 down to 300. From there, doing that exercise, amenity by amenity, and again, you don't have to go with sheets and Wi-Fi and stuff. Everyone's going to have that. I'm talking about desirable amenities. By doing that, you can see what is absolutely necessary, but you can also find out where the opportunities lie. We did that exercise in Ellicottville, and we saw there were 650 properties, 200 of them had hot tubs. So that's a pretty high percentage of properties that have it. To me, that was like a no-brainer. You need a hot tub, because now people that search for hot tubs, you're going to be found, versus before when they click that amenity, you're not searchable. Where the opportunity was EV chargers. You went from 650 to less than 20 properties, and that's like a couple $1,000 investment and becoming a lot more popular. So we just from that exercise alone, you know, without having to pay for subscriptions or whatever, we thought, hey, let's invest this $2,000, put the EV charger in, and now we're, you know, instead of one of 650, we're 1 in 20. And doing those kind of exercises, looking within year over year, is something that we find so powerful, because now that person that has a Tesla is more likely going to stay at our place and make our place a priority over all the other ones, especially if there's not a ton of charging stations around.
And what our actual favorite amenity to put in, which is actually really surprising, is string lights. It just like... the photos, it looks so nice when you have outside string lights along with like a nice patio set, and whatever will capture the guest's attention to look at that listing and be like, I will pay a premium to put myself in that photo. That's what you need to look at. It doesn't need to be that your couch needs to be $2,000. It doesn't need to be super high end, but just finding those little things like these string lights we get from Costco for $50, right? But every time we put them up, you take the photos with professional photographer, not your iPhone. And that is what will sell your listing, because people will pay that premium to be exactly where you are in there. And then when they are showing up at your house, making sure that they are actually getting that 5-star stay, because other ratings of 5 stars will tell other guests that, hey, other people paid a premium to be here and they loved it, so that's what I want. And I just want to caveat this too with, I know it's expensive to buy. These properties, the one Spencer said, Niagara on the Lake, that does well, it was over $1 million property. We have investors on most of these properties, or partners on most of these properties. So anyone listening, like, they really don't need to go out and do it alone. There are skills that you have that you can put forth into a partnership, whether it's completely 50-50 or you have the handyman skills and someone else has the operations skills, or whatever it is. Don't think you need to get the whole down payment in there yourself and all the renovations and all of that stuff, because there are different ways.
Well, you guys definitely are coming off, like, to me, first time meeting you, you're coming off as real experts in this. So congratulations on everything you've built. And I'm sure you guys can talk about this all day, but just to wrap things up, do you want to share how people can reach you and like what services you're focusing on providing?
Sure. So we're mostly on Instagram, just at Spencer and Ashley. That's where you'll find us the most. Services we're looking at, we're always looking to raise capital and to acquire. Like you said, we've done this for a number of years. We know what we're doing. We know how to identify and curate a successful short-term rental now, and we want to do that on repeat. So we are partnering with others to do that, and then we have our management company as well that we manage and provide a 5-star experience for our guests on behalf of other clients.
Awesome. Thank you guys. Really appreciate your knowledge and everything you've shared, and I look forward to seeing you again soon.
Thanks for having us.
Thank you.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.